Hello friends, welcome to a new video. Today I want to teach you how to understand candles, recognize candles, and be able to understand what the candle is telling us without memorizing or learning them by heart. Just as you know, the candle is the language of our chart. And also, I want to teach you how to use it and its theories and rules, and also how we can open a position with it, which by itself can cause us to profit. But to increase our profit, we need to improve ourselves. But before that, if you're seeing us for the first time, be sure to subscribe to our channel. On the channel, we teach you technical analysis, and every day we post Bitcoin and altcoin analysis for you and give you signals every day. If you already know us and have followed us before, definitely like and hit the bell so you're notified of our latest uploads. If you want to get 3 or 4 free signals daily, definitely join the Telegram. There we can profit well together every day. If you want to talk with other traders and want to participate in future competitions that we will hold in the future when our team gets bigger, you can definitely join our Discord and you can talk to others and you can share your own ideas, and based on that, you can earn a score. If you want to stay informed about our news, definitely follow our Instagram. All of these links are in our bio. Well, I won't talk anymore. Let's get into the video. Well, before everything, what is a candle at all? A candle is a graphical shape of the market that shows what the market is telling us, meaning it's the language of our market. And each candle is customized based on your time frame. For example, if your time frame is 1 hour, that means each of our candles takes 1 hour. If your time frame is 1 day, that means each candle takes 1 day. And that the daily candle is made of 6 4-hour candles, because 6 4s make 24, and each day has 24 hours. And based on this, candles are formed together. That is, a 1-hour candle is made up of 4 15-minute candles, and so on and on. And what parts is a candle made of? A candle is made of 4 parts. If I want to tell you the place where it started and began, that is open. The place where it closed, that is close, and the place where your candle recorded the highest price, that is high, and the place where it recorded the lowest price, that is low. Each of these is abbreviated as OCHL, which, as you see here, it says O, then H, then L, then C. These show the candles open, close, high, and low. We show the candle, you see that it writes a series of numbers that show where this candle had its highest price, where it started, where it closed, and where its lowest price was. So based on this, candles show us like this. Now there are some shadows, some bars at the top, which are called shadows. What do shadows do? The shadow is the place the price went highest and the lowest, meaning it shows the fluctuations of that market in that candle. Up to this point, it shows down, that shows that the candle in this 1 hour, for example, in the 1-hour time frame, in that 1 hour that it was fluctuating, the lowest price that it recorded was here. And with the shadow, it shows this part. If we want to say the highest, it shows that this candle in the 1-hour time frame, meaning in 1 hour, the highest price it recorded was this point. Now, if the candle that we started from, the price increased from there, our candle becomes green. And if the candle we started from, the price became less, the candle becomes red. Now, for example, if I show you here, when we see a bearish or red candle and it closes here, the next candle starts from right here. But if we see a bullish candle, it closed here and starts from here. So we have to be careful and not confuse this. That is, the bullish candle here becomes the open, here close. The bearish candle is exactly the opposite. That is, here is open and here is close. Now, we have some important candles whose names are not important at all because they only cause you to get confused. What's important is to understand what the candle is telling us, because candles can be one of the most complete tools for analysis for us. For example, we have a candle, for example, we are in a downtrend. Okay, we are in a downtrend. And as you can see at the end of this, for example here, it gives you a shape like this, meaning here after this bearish candle, it shows you 2 candles like this, or one of them whose color doesn't matter at all. For example, when such a candle is shown to us in a downtrend, whose lower shadow is long and its body is thin and its upper shadow is short, it is one of the most important signs for a trend reversal. What does it show? It shows that the sellers exerted effort up to this point and brought the price down to here. But then buyers suddenly entered the market and pulled the price up a lot. This indicates that in the following candles, the buyer's strength might be significant. And as you can see, we got a very strong green candle. Now, let's look at the exact same situation in reverse. If we're in an uptrend, meaning a trend like this, and we see a shape like this at a certain point, it could signal a trend change to bearish. What is this? In an uptrend, the upper shadow should be long and the lower shadow short, exactly the opposite of what we see in downtrend candles. This can be a strong signal of a trend reversal. What does it show? It shows that within 1 hour, the price was pushed up significantly, but the sellers were so strong that they managed to pull the price down and close the candle with a small body. In fact, the sellers won. But in this particular candle, again, its shadow is even longer, which is an even stronger sign, and it has no lower shadow at all, which is an even better sign, showing that sellers are very strong. This tells us that the buyers pushed the price up to this point, but the sellers forcefully brought it down. When something like this happens, we should expect a possible trend change. The price dropped here. But then, as you can see, such a candle appeared, meaning the upper shadow is long, and even though the trend is bullish, the price still went up. What's the reason? The first reason is, candles alone are never 100% reliable in the market. If everyone could make money just by identifying a single candle, everyone would be a billionaire. So, first, never enter a position just based on a candle. Second, the location of the candle is very important. For example, if we're in a downtrend and this kind of candle appears at a support level, it's way more important than if the same candle appears somewhere in the middle of the chart. Now, what is a support level? Support and resistance are two key concepts. Support is a level, a kind of floor, where buyers enter and don't let sellers push the price lower. Like here, you see the price came down and here buyers stepped in and pushed it back up. They didn't let it fall further. Resistance is the opposite. It's a ceiling where the price can't go higher and sellers step in to push it down. You can see right here the price hits resistance and falls. Here's support, the price hits and bounces up. Here it gets close and drops. Again, that's resistance. It comes up here, nothing happens. Then again, it rises, hits resistance, and drops. Here's support, it touches and rises with a shadow. And then look, it breaks. Let me tell you something. If support or resistance breaks, the chance of moving to the next support or resistance level is high. Because when a support or resistance breaks, it shows that buyers or sellers no longer care about that level, and there's a high chance it'll break and fall further. Because if buyers were really active at that support level, they would have protected it. It wouldn't break. So this is very important. Now, as I was saying, a candle only really matters when it appears at a support or resistance level. For example, if we're in a downtrend and see these kinds of candles at support, that's a much better sign than seeing them randomly in the middle of a move. Same in an uptrend. If such candles appear at resistance, the chances of reversal and confirmation are much stronger than if they appear mid-trend. I just wanted to emphasize that this is a very important point. Now let's talk about volume. As you can see, we have an indicator called volume. If you go to the indicator section and type in volume, you'll see the first option is this. If you add it, you'll see something like this on your chart. What do these show? They show the volume of each candle, meaning how much capital entered that candle. For example, look here. A very large candle formed due to strong selling pressure, and you can see that its volume is much higher than the other candles. Or, for example, here, the candle dropped significantly, but buyers entered the market. Look how much volume it had, and that in itself can be a sign of a potential trend reversal. There might be a correction here. Why? Because when a high volume candle forms right after a strong move, and buyers can shadow the candle and pull the price up, that can be a sign of a short-term correction, meaning the price might rise a bit, then drop again. So volume is very important for us. And the higher the volume of the candle we're observing, the stronger the signal it can give us. One more thing. If we're in an uptrend and suddenly a candle like the one I just described appears, and the previous candles had increasing volume, but this one shows decreased volume, that can also be another signal of a trend change. So that was everything about candles. And remember, we should never look at candles in isolation. The candles that came before are very important. For example, take a look here. The candles went up and then dropped. You have to look at the whole group of candles together. We can't make a decision based on just one candle. A single candle isn't enough to justify entering a position. It's more like the final confirmation, the last signal before you take action. All right, that wraps up our talk about candles. If anything else comes up, I'll mention it later as a note in future videos. Now, let's move on to the next part. Before I tell you this, there are a few rules that I'll explain to you. The first are internal rules. The second rule says the market has 3 types of trends. The third says trends have 3 phases. The fourth says a trend continues in its path until a reversal is seen in it. The fifth says averages should confirm each other. The sixth says volume should confirm the trend. Today we will work with some of them and not with others. The second rule, we will deal with for now. It says the market has 3 types of trends. Primary trend tell us. The primary shows us the main direction of the market. For example, in this part, if you look, even though in some parts the price has fallen, meaning we went up like this, and in some spots it dropped, overall you can see that our trend has been bullish, and in general, the price has been increasing and has risen up to this point. So, the overall market trend usually lasts from months to years. Now, when can we know that our primary trend has changed? For example, we have a primary trend like this, upward. Our bullish primary trend ends when it comes and breaks the low where the price had started rising from and stabilizes below it. That means if the price comes down and breaks this, then we can say that the primary, meaning the overall market trend, has changed. This can be a good sign for our short positions. Now in a downtrend, if our primary trend is bearish, when the price comes up and breaks the top, the high from which the fall had started, meaning here, we can say the overall trend has changed from bearish to bullish. Now after the primary comes the minor trend. What does the minor trend tell us? If we look at some parts of the market, for example here, we can see that the market is in a range trend. Sorry, let me correct that. The market is in a ranging trend, and as you can see, the price is fluctuating in this same spot and hasn't come out of this rectangle for a while. This is the minor trend. The parts of the market that are in a range trend and fluctuate inside that rectangle are called minor trends. We can open many positions with the minor trend. What does it show us? If we have a minor trend, for example, like this, and this is its ceiling and this is its floor, if the minor trend comes up and breaks above this line of the rectangle or comes down and stabilizes below the bottom line of the rectangle, we can open a short position. So the minor trend, if it breaks from either side, can give us a chance to take a position. Now, a few points are left that I'll tell you. We have 2 types of markets, as you might know, or maybe you don't. Bull market, which is our upward trend, and bear market, which is our downward trend. Bull market, or our upward trend, as you can see, it creates higher highs and higher lows. Here's a high, then a higher high, then another higher high, and it keeps going like this. The same with the lows, higher low, and so on. Now, a bear market is exactly the opposite. It creates lower highs and lower lows. High, lower high, lower high, low, lower low, lower low, and it continues like that. These are the 2 types of trends we can have in the primary trend, whether bullish or bearish. Now, secondary trend. The next part. These are the parts that react opposite to the primary trend. For example, if you look here, we had a bullish trend. This spot, overall, it was bullish. But in some parts, the movement of the candles went against the trend, and these are called secondary trends. It's a reaction to the primary trend, meaning if our trend is bullish, the secondary becomes bearish. If the trend is bearish, the secondary becomes bullish. So it moves exactly opposite to the primary trend. Now, the secondary trend has a limit. It must not go beyond 2/3. If that happens, it means our primary trend has changed. For example, if we are in a bearish trend and it goes like this, it shows the primary trend is changing. But we still wait until this level is broken so we can act more confidently to avoid unnecessary stop losses and unnecessary losses. Now, the next rule says trends have 3 phases. After a strong drop, we enter a range market, a range trend, a range rectangle, which is exactly our minor trend. And this rectangle is very important to us. Why? Because after it breaks the top, we can take a long position. That means if it breaks here and stabilizes above it, this becomes the accumulation phase, meaning after a sharp drop, it goes into a range rectangle, and after breaking its top, we can enter a long position. Rephrasing for clarity and flow. And as it moved into the range rectangle, volume began to drop. That serves as a confirmation. Then once this level is broken, volume needs to rise again to provide us with stronger confirmation. Let me find that. Here it is. As you can see, this is a range trend following a fairly sharp decline. As we progressed, the market entered this range, and after breaking this point, we had the opportunity to go long. If we had taken a long position here and closed it here, we could have gained about 2% on Bitcoin. For other coins, it would have given us a 3 to 4% profit. Now, depending on your chosen time frame, these confirmations become more precise. The higher the time frame, the more reliable they tend to be. And depending on your time frame, you can get better confirmations, because the higher your time frame, the better confirmations you get, and the more likely your analysis is to be correct, since it shows the overall market. The next part, which is the distribution phase, is exactly the opposite. When price is rising and then enters a range and then falls, yes, it rises, ranges, and then drops. And this is exactly the opposite. If we want to break it down, when the price is rising sharply, volume must increase. And while we're in the range phase, volume should decrease. Also, during the breakout, volume should increase again. You just need to pay attention to this. The volume doesn't need to be exactly 100. It doesn't have to happen in such a strict way, but ideally, that's how it should be for a better confirmation. The next part is the trend phase. The trend phase comes exactly after the accumulation phase and the distribution phase. After it breaks out, it enters this phase where the breakout happens, price moves upward, and we enter a bullish trend. This is called the trend phase. Now, in the next section, I want to show you how we can open or close positions based on trend changes. In an uptrend, we make higher highs and higher lows, right? And the trend continues this way until the opposite is proven. So in this uptrend, as long as this low is not broken, we cannot confirm that the trend has changed. Now, based on this, we form higher highs, then suddenly a lower high is formed. Then with the break of this low, we can enter a short position. This clearly shows a trend reversal. A lower high was made and then the low was broken. And that's a strong confirmation of the trend change. Well, not 100% confirmation, but still a very solid one. Now, the next part is quite similar, but don't confuse them. In an uptrend, suddenly a lower low forms, then a lower high. And then with this break, we can open a short position. So what happened? In an uptrend, 1 lower low, 2 lower high, 3 breakout, 4 short position. That's it. There are 2 very important patterns here. Also, let me show you some other shapes. One is the double top and the other is the double bottom. The double top forms the shape of an M. So it looks like this. That's a double top. The double bottom is exactly the opposite. It forms a W shape, like this. Now, what can we do with the double top? It creates this kind of shape indicating strong resistance. Price touches it twice. And for example, if this is the market structure, we must wait for the break of the base of the M. That's the bottom of the double top. When it breaks, we can open a short position. If, for example, we were watching the chart here, we could have opened a short position on the break. Let me give you an example. In the weekly time frame, if I want to show you Bitcoin, although the shape isn't perfect, we can still consider it a double top. Price went up here, created a peak, came down, made a base, went up again, and we could have opened a short position on the break of this level. This drop gave us a 10 to 12% profit in Bitcoin. As you know, higher timeframes give better confirmations. Next pattern is the double bottom. It's the W shape, just like the opposite of the M. With a break of the neckline, we can open a long position. This can be a great position for us. One important note, in a double top, when you open a position on the break, your stop loss should go above the highs. In a double bottom, when you open a position on the break, your stop loss should go below the lows. That's a very important point I wanted to share. Also, let me give you a tip about long-term positions. Let's say we enter a long position here. Price goes up, okay? It makes a high, then makes a higher low, then breaks the previous high and stabilizes above it. Our initial stop loss, for example, was here. Now we move it up and place it below the new higher low. So what happened? It made a higher high, then a higher low, then broke the previous high and stabilized. That means it's headed for another new high. We move the stop loss below that low and we keep going. Once another higher high and higher low form, and again we break the previous high and stabilize, we move our stop loss again from here to the new higher low. Then it goes higher again, makes a new high, new low, breaks it, stabilizes, we move stop again. We continue this trend until the price suddenly drops, breaks our last low, and shows that the trend is changing. And we close the position in profit, which is very important. This exact logic applies in a downtrend too. Let's say we're in a downtrend and enter a short position here. We set the stop loss here. As the price creates a lower low, followed by a lower high, and then breaks that previous low and stabilizes, we move our stop loss above the most recent lower high. That way, if the price retraces upward, we're still in profit. The stop is locked in profit. If the price drops again, forms another lower low, followed by a lower high, and breaks the previous low, we shift the stop loss once more. Our profit continues to grow. It becomes a guaranteed profit. We keep doing this until the downtrend concludes, when the price breaks the most recent lower high. At that point, the stop loss is triggered and the position closes in profit. Then, once the trend reverses, we can even look to open a long position on the break of the new high and capture more profit. The same rule applies in reverse. In a downtrend, if the price breaks a low, forms a lower high, and then breaks that low again, that's a classic non-failure swing, and it gives us an opportunity to open a short position. That's it. Nothing more needs to be said. If you're following these steps and plan to enter a trade, here's one more key point. In an uptrend, if you open a trade after a breakout, your stop loss must be placed below the most recent low. In a downtrend, if you open a trade after a breakout, your stop loss must be placed above the most recent high. That's another important tip I wanted to pass along. That's all. I've covered everything. If you want to get 3-4 strong trading signals per day, we can highlight hot opportunities. Join our Discord community. As our team grows, we plan to organize trading competitions, share market ideas, and more. If you'd like to stay up to date on project developments and market updates, follow us on Instagram. We post there regularly. Also, feel free to follow us on TradingView to keep with the markets if that interests you. If you found this video helpful or enjoyable, please subscribe to our channel, give it a like, and hit the notification bell so you'll know right away when we upload a new one. That way, you'll keep learning, sharpen your technical analysis skills, and grow as a trader. If you liked what we're doing, drop a comment, and if you have any questions, feel free to ask in the comment section. We also offer a VIP group with a small fee where we share higher quality and real-time signals, mostly on 15-minute or 1-hour timeframes. You could get up to 10 signals per day. But if you're unable to afford it, no worries at all, brother. What matters is your growth and your profits. If you're facing financial issues, just message our admin on Instagram. We'll work something out. We might even give you free VIP access. Don't stress. We'll do whatever makes sense for you. And if you'd like to support us, even just subscribing means a lot and helps us greatly. That's it. Hope you enjoyed the video. Let me just add, using these strategies and candlestick analysis, you can easily achieve a win rate of 40% or more. That's not a small number. 40 to 50% is excellent when combined with proper risk management. Even the top traders in the world usually max out around 70%. Whether you're trading with $10 or $1,000, a 70% return on your capital is a meaningful and respectable outcome. So keep that in mind if you follow everything: capital management, risk, reward ratios, and discipline. You can absolutely earn great profits and stay strong in the market. We're continuing this course to help more people and to show that trading is not gambling. It's a profession, a skill, and if you treat it properly, it can outpace inflation, but only if you follow the rules of the market. That's it. Nothing more to add. Much love to every one of you. Respect your parents. May your pockets be full and your body be healthy. See you in the next video and tomorrow's analysis and educational content.